as regional banks continue to tighten credit. Direct lenders, private credit share of the market will continue to increase. There's going to be more and more private credit allocations. The U.S. regulators are coming down harder and harder on regional banks. They don't want to see what happened to Silicon Valley Bank or Signature Bank happen to others. So they're increasing capital requirements, regulatory capital requirements on regional banks, which is going to slow lending. So here's my thoughts this year. Number one, volatility is going to continue until there's a continual period of stabilization. I think we're getting there. I think by the end of the year, we'll know in the U.S. that interest rates have stabilized. Inflation is not checked, but it's not getting worse, which is the good news. Number two, with the U.S. economy continuing to prove resilient, we expect that interest rates will stay high. I don't believe that interest rates are going to come down like most. It's not good for the home industry, for the building industry, for the mortgage industry. But from a middle market company and from a financing standpoint, I think you have to assume that interest rates are going to stay where they are. Next, early stage venture capital equity funding are going to be very hard to come by. Funds are not being raised in this area, and it's very hard for companies that otherwise would generate venture capital funding to continue. Recent IPOs and M&A upslide has shown that the valuation gap between buyers and sellers is closing. For the last year and a half, sellers had an overinflated view of purchase price multiples versus what buyers are willing to pay, and we're starting to see that come down and narrow. I think 2024 will be a year where we'll see more M&A, an uptick in M&A. Last 2 years, M&A has come down off of 2019 levels. PE fundraising will slow, and holding periods will be longer, which means in private equity, IRRs will come down, and money on invested capital multiples will come down. Buy and build strategies will remain the driver of M&A. Platform investments will be made, but because of the multiples that platform investments are made at, it's important to do add-ons and tuck-ins to bring down average multiple prices. Next, China, much worse shape than they acknowledge or that people realize. The deepening property crisis and turmoil in its financial markets are just beginning to set in, and it will cause investors to be on edge. There's no other leading economy in the world that's been lowering their interest rates over the last year other than China. The government set up recently a fund to backstop public securities. I think it's much worse than people realize. Next, the U.S. dollar will continue to show strength, creating challenges for many world and emerging market countries. Remember, most of the emerging markets borrow, and that borrowing is generally done in dollars. So when interest rates increase and when that money needs to be repaid, it becomes very difficult for many emerging and non-emerging countries to make those debt payments. And lastly, private credit, because of all these things, will continue to be the fastest growing asset class and will be the safest place to hide in periods of economic turmoil. Private credit is a young asset class. Think of private equity for a moment. Private equity is a much more mature asset class. Private equity developed initially as a generalist asset class. Private equity firms did deals in all different sectors, all different sizes, all different industries. And then over time, what happened is private equity got specialized. Today, there are no generalist private equity firms. There's consumer private equity, there's business services private equity, there's retail, there's consumer-focused private equity, there's software, there's technology, there's all different types of private equity firms. That's going to happen in private credit. Private credit will specialize as time goes on, and they'll specialize not only by industry and business segment, but also by size. There's 3 markets in the U.S., and for Europe as well. There's the large market, which is the broadly syndicated or the public market. That tends to be $100 million EBITDA size companies and above. There's the upper middle market, which is the $50 million to $100 million EBITDA size. And then there's the lower middle market, which is the $10 million to $50 million EBITDA size. Now, Europe happens to all fit pretty much in that one market, that lower middle market, the 10 million, the 50 million. But in the U.S., there's three distinct markets, and institutional investors will have to exposure in each one of those three markets, the broadly syndicated market, the upper middle market, and the lower middle market, in order to create a balanced private debt portfolio. And then as time goes on, institutional investors will want software exposure, they'll want technology exposure, healthcare exposure, business services exposure. So no different than the private equity asset class. As the private debt asset class matures, we're going to see much more segmentation by market, much more segmentation by industry. And in order to build a portfolio, investors will need to have all of that in the portfolio to create diverse exposure. Because if you only go to the very large firms for private credit, what you're going to see is you're going to see the same exact exposure in every one of those firms because they're all syndicated club deals. So if you go to four of the largest private credit providers, you're going to see the same deals. And an institutional investor does not want that. We happen to focus on the lower middle market as a firm. And over 25 years, we've stayed there. And we've stayed there because it's better. Our investors make more money. LPs make more money in that space, and we make more money. So if you're purely a capitalist, you go where your investors are going to do the best. Pricing is better, leverage is lower, defaults are lower, and recovery rates are higher. And that's all because the companies are smaller. So you can maneuver better in that market. Now, that's both an advantage and that's a disadvantage because the companies are smaller. The companies are not billions and billions of dollars in revenue. Most of our companies are anywhere from $100 million to $1 billion in revenue. We just have to be more mindful of that and monitor those deals better. I have 250 employees, and we manage, as I said, about $18 billion. There's firms that manage $100 billion with 100 employees. So that's a better business model. You have less employees, more AUMs. We're more profitable for our LPs because we generate wider spreads, but that entails more work. So the one thing that a lot of the large managers don't like is that the space that we operate in is a much more management and people-intensive space. We have originators that originate. We have underwriters that underwrite transactions. We have credit team that provides credit risk, and then we have portfolio management teams that manage once the deals are closed. We have 4 different sets of eyes on each loan transaction, and it's more work and it's more costly. But after 25 years, I can tell you that it's a good decision because it's generated a lot of good returns for our LPs over the years.